Hi everyone, welcome to EFG's podcast Beyond the Benchmark. My name is Mo Zafsal, I'm the Global Chief Investment Officer for EFG. So we have Andrew Harradine on the podcast today. I think, Andrew, you did make an appearance last year, I believe, roughly around this time?
Yeah, that's about right. But great to be back on the podcast. So thanks for having me again.
Yeah, not at all. So for those of you who don't know Andrew Harradine is our head of global fund selection, manager selection, and he's been with EFG for 10 years, possibly a little bit longer. And I always describe Andrew as one of the most powerful people in EFG on the basis that he has the power to select a manager or select a fund into that famous approved list and to make it into the Mutual Fund Matters publication that is certainly a must read for anybody who gets hold of it. So Andrew, how do you think about that?
Oh, thanks for the plug there. But yeah, I guess given our high AUMs in mutual funds now, a lot of managers want to get onto our approved lists. So yeah, we receive a lot of phone calls, and we're clearly in demand.
And obviously, you have a great team in Lugano and London who support you. So let's go straight into it. And for this podcast, we basically have three kind of key topics. The first is general trends within the asset management industry. Obviously, Andrew is very close to that. And then some of the newer trends we've seen around thematics. And then obviously the big mega trend within the industry is, of course, ESG. And so we'll certainly be enlightened on Andrew's thoughts. So Andrew, so maybe as a first question, what are you seeing in terms of kind of flows this year? Have we started to see the great rotation that everyone was hoping for between fixed income and equities, and where is that money going at the moment?
Yeah, really good question. So it's been a really strong year for flows across a lot of risk assets. Every month we track Morningstar's flow data, and we've seen just over 360 billion of net flows coming into across the piece, really, equities, fixed income, multi-asset. So this year equities have been dominant with just short of 170 billion coming into equity funds, around 110 billion into fixed income, and 75 billion into multi-asset. I guess we obviously had some volatility in fixed income, sovereign fixed income markets in the first quarter, which has slightly muted flows into that area. Conversely, equities have been very strong, so maybe no surprise we've seen such strong flows into the equities space. One area which maybe has been somewhat more muted in terms of flows than would have been expected is commodities. Having seen some very strong performance from commodities this year, we've only seen a few billion of net flows come into commodities. So it's been all about equities primarily this year. If we dig a bit deeper into where those flows have been coming within equities, one of the enduring trends that we've seen in recent years, and indeed continue this year, is global equity large cap has been very much the dominant area of flows on the equity side of things. Other points to note would be some of the more sort of thematic sector oriented peer groups. So we've continued to see very strong flows into technology funds, but also energy has actually received some meaningful flows this year, having been out of favour for many years. We've seen a bit of a more interest in US large cap value. Having been previously out of favour for many years. We saw a strong run over the earlier part of this year, which saw some meaningful flows come into the value space. Conversely, despite value and growth now being in line on performance this year, we've seen some pretty meaningful outflows from large cap US large cap growth managers, which given the reasonably strong performance of that space, isn't really what we would have expected. And maybe just to touch on fixed income briefly, one of the areas where we've seen some meaningful flows has been in the Asia fixed income space, and one of the sort of the subcategories here is the RMB onshore bond peer group, and this sort of ties in with an asset allocation call that we made earlier, and I think there's a greater acceptance of RMB bonds currently, and I think if you look at the performance of that space this year, it hasn't seen anything like the level of volatility we've seen in traditional rates markets with RMB bonds holding up very, very well. So that's been an area of interest clearly for investors so far this year.
So the big I guess underperformer this year has been on the emerging market side. Any trends on, say, emerging market equities or indeed sort of China or Asia? Obviously, has been a little bit more volatile, and also the same thing for in emerging market fixed income has always been historically quite a strong category.
Yeah, so I guess the area that stands out on the equity side is China equities, where inflows have been very, very strong. Certainly, I mean, I guess with the more recent volatility in the China tech space, we're probably going to see that, soften when the next month's data comes in. But given how well A shares performed during 2020, we've seen a lot more interest in that part of the market. So strong flows in China equities. And then on the EMD fixed income side, we have seen some modest inflows in that space. I guess the hard currency markets will have suffered some of the volatility associated with US rates, which has perhaps sort of muted interest a bit in that space, but still in net positive territory on a year-to-date basis.
Obviously, one of the trends you noted was around thematic investing, and certainly within EFG, we've seen that quite prominently with some of the, excellent performing launches that we've done ourselves. Are we seeing similar trends in the marketplace to the trends we've witnessed internally within EFG? Yeah,
definitely. I mean, if we take an area like healthcare, that's had a net inflow of over 6 billion so far this year. The financials area has had a net inflow of around 4 billion. We've definitely seen some very strong inflows on the thematic side of things.
What do you think's been the catalyst to that? Because obviously, some of these sector funds strategies have been around for a very long time. There's nothing new, nothing obviously particularly innovative to that. What do you think has been the catalyst for everybody to start thinking about thematic investing as a serious allocation in portfolios?
I think it's partly linked to some of the prominence of some of the underlying themes, and I guess ESG, climate. We've seen a step change in investor interest in those areas. So on the climate side, obviously, with the arrival of the Biden presidency, a much more sort of supportive US government for the climate space. Obviously increasing regulations with respect to ESG, climate. So I think ESG and climate funds are very, very clearly on the map for investors, and indeed the expected growth rate of some of those companies over the coming years, given the moves to decarbonise the global economy. It's sort of no surprise that that's catching investor attention. Other areas, technology is one of the dominant sort of thematic areas. Obviously tech has been an area of, very strong earnings growth, realised performance for many years now. So it's, perhaps no surprise that investors continue to be, very interested in that space. And I think, there's clearly many more ways of playing thematics. Now, there are, we've had a lot of launches. Just looking at some of the Morningstar data, there were 237 thematic funds launched in 2020, up from 170
wow.
in 2019. So, a lot of launches in this space. Morningstar sort of suggests that thematic funds have performed well versus global equities over the last 12 months. So I think a combination of strong performance, more ways to play, themes has captured the imagination of investors.
So, kind of thinking through from both from an institutional perspective and then a wealth management perspective, I guess one of the underlying trends is what I call kind of passive and satellite, where passive has become as low as fee as possible, tracking an index on the institutional world, and then you have, call it active and then hyperactive, if there is such a word. But you kind of have the active part with your traditional active managers that, as we've generally seen over the last 20 years, they've just generally been shrinking as part of the pie of the overall asset allocation. That has become smaller, but it seems to me that people are then replicating, or maybe disaggregating that active management piece into this other sliver that is the hyperactive or the thematic investment, and typically I guess that smaller segment will also have higher fees to it. So the providers themselves are probably very keen to get into that space, hence I guess the number of product launches that we've seen there. So that's there. And I think on the wealth management side, I think there's always been a strong interest in either doing good, for example, in ESG or climate, but also backing themes and trends that they think are going to be very pervasive, particularly over a long period of time, rather than kind of the short term, where sometimes these things can get overblown. So there are, from a structural perspective, portfolio construction perspective, we're definitely seeing people disaggregating their portfolios into different buckets to play those themes. I guess, it's been quite encouraging to see companies like Morningstar starting to provide better data and more transparency around thematic investing. What are your thoughts around that? What have they been doing to change with the times, if you like?
Yeah, that's a really, really good point. I think trying to, get one's arms around the thematic landscape has been, historically very, very challenging. Funds might have just been all sort of lumped into, a global equity peer group, or maybe a just simplistic sector peer groups, but that hasn't really sort of captured the essence of the evolution that we've been seeing in thematic investing. So Morningstar have broken the universe down into 4 broad categories, and in each of the thematic funds I'll put into one of these 4 categories. The first being a technology, as we were sort of touching on a few moments ago. The second is called physical world, which areas like climate transition, energy transition sort of funds would be included in that space. The third is social, so things like demographics, for example, might be included in that bucket, and the final one is more of a catch-all, which is a sort of called broad thematic. But I think they obviously have these sort of 4 top level categorizations. And then they sort of start to break things down into more specific themes. So technology is definitely the dominant theme, with 320 billion of AUM there. The next largest is physical world, with 130 billion of assets, with social at 93 billion, and broad thematic at just under 50. And then if we look at some of the largest sub themes, we can see areas like, the largest one is energy transition, and then we have areas like digital economy, robotics, consumer, life sciences, AI, security, fintech, etc. So, it's relatively early days in terms of Morningstar's analysis in this area, and some of it isn't sort of publicly available on their website yet, but can be received on request. But I think it will this sort of evolution from Morningstar will definitely help us to do better analysis in terms of sort of comparing thematic funds in terms of performance, positioning, etc. So yeah, definitely view it as a real positive step.
So obviously a lot of people might think this is just kind of a bit faddish, and the next market correction they'll all die, and so on and so forth. So certainly we're old enough and grey enough to know some of those things that can happen. It certainly seems a little bit more permanence to this than there was maybe in the past, where it was very much concentrated in, say, one sector, gold miners or technology or whatever. It seems to be a much more broader array of products, and it does certainly feel quite different. The obvious one that people think is the faddish investment is obviously ARK, or Cathy Wood, who's virtually on every podcast. Maybe we should get her on this one, but she's on every podcast. CNBC interview, Bloomberg interview, newspaper. So she's out there a lot, and obviously she's probably been one of the big champions of the thematic investing drive. What are your thoughts of ARK?
So yeah, as you say, I suspect very few, if any of us, had heard of ARK 3 or 4 years ago. The firm was founded in 2014. They're now up to 58 billion in AUM. They have only 26 staff members, so they have a cost-income ratio.
Wow, off the charts
to die for.
I'm sure Giorgio would be envious.
And in terms of AUM compared to the other large sort of global thematic players, that they're in second position.
Wow.
Globally, behind Pictet and the largest US thematic player by a country mile. So they have been hugely successful, and their flagship product is the ARK Disruptive Innovation ETF, which is up at 22 billion AUM. They have their genomics product at 8.7 billion, fintech at 3.8 billion. So, a number of very, very successful products. And I guess one of the key innovations at ARK is offering an active product wrapped in an ETF. This is, it's not sort of unknown. There are sort of a number of active ETF products in the market, but I think really getting active ETFs on the map, they're going to be one of the dominant players in that space at the moment. I guess in terms of our assessment of the products, we have had a few meetings. With them. There's no doubt that they are invested in very interesting areas of the market. But I think one of the observations really is in terms of sort of concentration risk in some of their products. So was looking at the ARK the innovation ETF this morning. They have 40% of their portfolio in the top 5 positions. So it's clearly very, very concentrated. And if one of the observations that Morningstar has made, and we would agree with, is on the liquidity of their portfolio. They own some very, very large stakes in certain companies. I think by their nature they are quite heavily invested in mid and small cap companies, and I think that sort of combination of portfolio concentration, large AUM, large percentage holdings in companies, and in some cases these names aren't that liquid. Combine that with an intraday liquidity of an ETF, and that there are some potential challenges there. So I guess that would be one of the areas of we would be a bit cautious on is the liquidity side of things.
Well, certainly I think at the end of each day, or usually the next day, we usually find out what they've changed in their portfolio. So it's just, and I suspect that's probably one of the reasons why there's so much excitement and interest in the products, because it creates itself a whole load of debate and transaction and discussion the very next day when their portfolio is released, and you get to know what they've just sold on, just bought and what they just bought and sold, and that creates a dynamic sort of and storytelling in itself, which I suspect is probably just reinforces the whole thing as well.
Yeah, I think that's absolutely right. I think there was a headline yesterday on some Japanese company they've been buying every day for the last few months.
Exactly. Yeah. So it's only interesting, and then obviously. I call it meme stock fodder. So anything that comes in or comes out is very quickly bandied around all the different websites and discussion forums, and obviously in itself creates some positives and negatives, and certainly certainly we've learned some prominent hedge funds taking short positions in the ETF as well as a result of it. So it is certainly a fascinating development, and it always never ceases to amaze me how much innovation appears in sort of, pardon the pun, how much innovation appears in the in the industry, and how it's able to feed on itself in this respect, and the interest that it creates. So obviously the other big mega trend within the investment industry today is obviously ESG. There's been some kind of very interesting developments, both very recently with accusations of greenwashing, as well as people wanting to invest in those things for good, and obviously the pension fund community, institutional community, is also ramping up ESG as part of their investment policies and frameworks. Obviously EFG and New Capital have been involved and on top of this for the last 4 or 5 years. Maybe you can give us kind of quick summary of some of the, because it's two trends. This is a regulatory trend, and we've got these new SFDR rules, which maybe you can enlighten us a bit more on, and as well as, if you like, the social trend as well. So there's actually two parts to this.
Yep, all very interesting topics. So maybe just briefly we can sort of touch on flows in this particular area. So there's been, in 2020 there were 530 sustainable funds launched according to Morningstar, and a further 250 traditional funds repurposed as sustainable ESG funds. So clearly a lot of launches in this space. In the first quarter of 2021, we hit an all-time high in terms of net inflows for that quarter of 120 billion into sustainable related products. So there's clearly a lot of investor demand in this space at the moment, and I think from an active management perspective, we're seeing the majority of those flows go into active products. So I think obviously the active fund management community has been under a good bit of pressure from ETFs over the last decade, but I think combination of thematics we touched on before and ESG funds, this is definitely more of a tailwind for the active management community, which is good to see. And one of the key events of 2021 so far from a regulatory perspective is that the sort of SFDR regulations were implemented on March 10th. So SFDR, Sustainable Finance Disclosure regulations, and this is where managers have to self-certify / classify their products according to various SFDR articles. So the key articles are Article 6, Article 8 and Article 9. So sort of Article 6 is more of a sort of a baseline, sort of basic integration of sustainability risks as a minimum standard. So we would sort of say a fund which I would say doesn't sort of very proactively, integrate ESG. Maybe there's a degree of integration, but it's not a focus. Would sort of fall into that sort of Article 6 category. Article 8 we would sort of simplistically categorise as being light green funds, which promote ESG characteristics within the portfolio. And finally, Article 9, sort of dark green funds, which have sustainability as a core objective of the product. So, but important to note that this is a self-certification regime at the moment, and the regulator is yet to issue its more sort of technical details with regard to the KPIs that each of these funds needs to align with. So that's actually recently been delayed, but I think mid 2022 this sort of more technical detail will be in place. So managers have between now and then to, I guess, sort of ensure that the products that they're classifying as Article 6, 8 and 9 are going to be aligned with the standards that are coming through. And but there's clearly a commercial pressure on managers to make their products appear as ESG friendly as they can, because that is clearly where the flows are going. And as you mentioned, a few moments ago, DWS has been in the press. There's some sort of whistleblowing situation with regard to greenwashing within the organisation. So I think until that sort of technical specificity is in place, there's going to be different interpretations with regard to what funds should be sort of Article 6, 8 or 9. But this is where it's important that fund selectors have a really sort of robust process in place, because one can't take self-certification at face value. We need to kick the tires and ensure that funds are meeting our internal standards for our own ESG classifications. So the way that we approach things is that for all funds on our approved list, we will essentially classify those funds as being either traditional funds, ESG integrated or ESG focused, and funds have to reach a certain scoring threshold to basically to become either ESG integrated or ESG focused. And we are looking both at funds from what I would call a bottom-up perspective, where we're using things like Morningstar's Globes ratings for portfolio assessments, or MSCI's data on particularly on the fixed income funds, and then combining that with information from the UNPRI organisation, who make a top-down assessment of organised asset managers' ESG attributes. We include that, along with, when we're interviewing managers, we will sort of talk to them about how ESG is integrated into the process, how they can evidence that integration with, good reporting in terms of the ESG traits of their characteristics of their portfolios, and then we sort of combine these sort of top-down and bottom-up inputs into an overall assessment, and then we can sort of see how that compares with the whether funds are being stated as Article 6, 8, or 9, and where needed, so I guess in identifying potential inconsistencies.
So recently, and we won't give the name out, but recently you downgraded a fund that you felt was greenwashing, and it's quite a prominent asset manager that one would be quite surprised at if we were to divulge the name, but we won't. What were the key things there that you had picked up on that because I have to say, personally, I was quite surprised that yourself and the team took quite a heavy stance on this. I'm quite intrigued to understand what the process was. What were the flags there that said, actually, this looks like a greenwash?
Yeah, it's a really good question, topical issue, and I think that the situation we had with this particular manager highlights the importance of having a holistic approach to assessing a manager's ESG attributes. So from a top-down perspective, this manager looked very, very good. They scored very well on the UNPRI side of things. So that all generally looked fine. But where we struggled was in two areas really. Firstly, was on disclosures, and the manager was, shall we say, unenthusiastic about providing granular ESG KPIs, exposures, on their particular portfolio. So that was a bit of a red flag for us. I mean, for most asset managers now, we get really good data in terms of the ESG attributes of products. So carbon exposures for example, and then the portfolio scoring from MSCI also looked pretty poor for the product. So I think even though it looked good from a more of a sort of a top-down perspective, when we sort of drilled down to the portfolio level and we were pushing for disclosures for a manager that was sort of claiming their product was an Article 8 fund, we just sort of felt that they were falling short, on transparency, and B on overall portfolio score didn't look great.
That's very interesting. Have you told them that these are the reasons why you're taking them off the list?
Yeah, as a general point, I mean, we're happy to have an open dialogue with the managers that we have on our approved lists, and I think discussing best practice, what asset managers are doing on this point, helps everyone to raise their standards. So yeah, we're happy to have an open dialogue.
So have you told them yet?
That's a call that'll be happening over the next few weeks. Okay,
we'll watch that. We'll watch that piece very carefully. As I said, we won't disclose that today. And Andrew, any other sort of trends that you want to talk about? Obviously, we've been quite comprehensive on ESG and the thematics. Anything else you think we're missing in this discussion today?
Maybe just to wrap up. I mean, I guess one of the key challenges of doing fund research over the last sort of year, 18 months or so, has been the COVID environment. Working from home. I mean, throughout my career as a fund selector, we've always done face-to-face meetings with managers. We've done a lot of on-site meetings, and I guess the whole fund selector community has had to adapt over the last 18 months or so to doing, whether it's Zoom based or WebEx or those sort of virtual meetings. So I think that's been that's had its challenges, and I think we have adapted. But I think getting back to doing face-to-face meetings and on sites with managers is definitely something that we're all looking forward to doing.
I was going to say it probably means that you're probably getting reasonable access for first meetings and second meetings, but because I guess everyone is happy to be on Zoom, than they were happier to be on Zoom than they were before. So I suspect there has been some benefits of being able to cover a lot more as well. So without taking that plane to wherever to ensure that they are actually doing, and they do have that office and they do have that those staff members. It's not a shell. So yeah, kicking those tires are absolutely important. I can certainly see that. So last question, Andy, for you. Obviously what you do is kind of quite critical, also very interesting. What do you think are the sort of key sort of character traits that you're looking for when you're selecting a manager? What are the things that you're looking for that is a big sort of green tick? And then on the other side, what is a red cross? And I guess in some respects you're the psychologist. You're trying to second guess whether someone's actually telling you the truth or not. I mean, what are the sort of tricks of the trade that you've learned over the last 24, 25 years that you've been doing this?
I guess couple of things that we would definitely look out for is overconfidence, and I think that seen it a good few times over the years. Managers that are take too much risk in individual securities, I think is something that we would sometimes struggle with a bit. I think investment often comes down to sort of playing the probability game well, and taking meaningful size bets, but nicely diversified within a portfolio, and not sort of betting the ranch on a couple of stocks. And I've seen over the years many managers almost sort of back themselves into a bit of a corner if one of their large stocks starts to unravel, and why bet your career on one or two stocks? So I think overconfidence is definitely something that we watch out for. I think on the flip side, managers that are humble, willing to admit their mistakes, willing to sort of move on, cut losing positions, etc. I think are traits that we look for, and I think from a fund selection perspective, one of the key things that we're always looking to do is to join the dots between stated investment process and data that we get on portfolios, and we spend a lot of time looking at sort of trading analysis, looking at consistency of portfolio attributes. And I think if we are unable to join the dots between stated process and what we're seeing in portfolios, that's always a red flag.
Very, very interesting. So Andy, absolutely fascinating as always. Thank you very much for coming on. I think certainly I've learned a lot in the last few minutes. That's great. So thank you very much for coming on. So that wraps us up for today. Thank you very much for listening, and we will talk to you again next week. Thank you very much.